As we head toward the opening bell on this Monday, November 3rd, 2025, shares of Plug Power, ticker PLUG, are active in the pre-market. The stock is currently indicating a price of 2.71 per share, which is a modest climb of about 2 cents, or 0.74% from last Friday's close. Now, for many holding this name, any green on the screen is a welcome sight. The expectation for a stock like Plug Power has always been built on a grand, sweeping narrative, the future of energy, the green hydrogen build-out, and a company positioned at the center of it all. But the reality of the pre-market tick-up is far more complicated because it comes against a backdrop of news that is deeply contradictory. Just last week, the company was celebrating a new 13.7% jump on supply deals, but this optimism is running headlong into a much darker operational reality. The most significant and perhaps under-discussed development is the recent confirmation that the U.S. Department of Energy has canceled nearly $8 billion in projects nationwide, and Plug Power's name appeared multiple times on those cancellation lists. This isn't a minor setback. It's a direct threat to the very subsidy-fueled environment the company needs to survive. So, while the retail investing world, particularly on forums like Reddit, debates whether Plug is a generational buy or a trash stock, the institutional players are placing their bets. The common ground everyone shares is that Plug Power is trying to build the world's first end-to-end green hydrogen ecosystem. This means they don't just want to sell one part of the puzzle, they want to be the entire solution. They are manufacturing the electrolyzers that create the hydrogen, building the liquefaction plants in places like Georgia and Louisiana to process it, and then selling the fuel cells that use it, primarily in material handling equipment like forklifts for major clients such as Amazon and Walmart. The bullish expectation is built on massive, impressive-sounding contracts. A 2-gigawatt electrolyzer deal with Allied Biofuels, another 3-gigawatt project in Australia, and the first deliveries to the Galp Signs refinery in Portugal. When you hear these numbers, you picture a company on the verge of dominating a multi-trillion-dollar industry. But the reality of the company's financial statements tells a story of survival, not dominance. The challenge is that building this ecosystem is costing the company everything it has and more. Plug Power is burning through cash at a rate that is simply staggering. At the end of the second quarter, the company had only $140 million in cash. This is for a company with operational plans that require billions. The cash burn, while management claims it is improving, is still expected to be around $500 million this year. This explains the constant need to raise capital, which leads to the other harsh reality, massive shareholder dilution. In the past year alone, the total number of shares outstanding has grown by 35.5%. Just in October, the company raised $370 million through a warrant conversion. This isn't expansion capital, it's survival capital. It keeps the lights on, but it makes it harder for every existing share to gain in value. This disconnect is where the trading volatility comes from. Last week's rally was a technical bounce combined with excitement over new deals. But analysts are sounding the alarm. Clear Street, for example, recently downgraded the stock to hold, not because the hydrogen dream is dead, but because the stock's valuation had gotten stretched and disconnected from these financial realities. They also pointed to significant transition risk as longtime CEO Andy Marsh prepares to step down, handing the reins over to Jose Luis Crespo. This is a critical moment. A new CEO will have to face the cash burn problem head-on, and the market is bracing for what that solution looks like. Will it be more deals, or will it be more dilution? This is why Plug Power has become one of the most contentious battleground stocks on the market, which brings us to the short-selling activity. The expectation for many retail investors is that a stock this beaten down, with this much high-profile news, must be a candidate for a massive short squeeze. The reality is more complex. The data shows that Plug Power is, without a doubt, one of the most heavily shorted stocks on the entire market. Depending on the data source, the short interest as a percentage of the free float is sitting between 29.5% and 33.1%. To put that in perspective, the average peer in its industry has a short interest of around 14%. Plug is more than double that. This means a massive, coordinated bet has been placed by institutional funds that this stock is heading lower. We can see from off-exchange data that the short volume ratio is frequently near 50%, meaning a huge portion of daily trading is driven by short side activity. But here is the actionable insight for investors, and it's a crucial distinction. What is your take on the rising short interest, smart money or manipulation? Many look for high short interest and assume a squeeze is imminent, but you must look at the cost to borrow the stock. On Plug Power, the borrow fee rate is currently very low, fluctuating between 0.5% and 1%. This is not the sign of a panicked, crowded short trade. It's the sign of a very confident, stable, and consensus bearish bet. The short thesis is simple and powerful. The company is chronically unprofitable, it dilutes shareholders to survive, and its entire business model is dependent on government subsidies, which, as the DOE cancellations show, are not guaranteed. So how do you track this? You can use platforms like Fintel or Ortex to monitor two key metrics. First, the short interest percentage. Second, and more importantly, the borrow-to-borrow rate. If that borrow-to-borrow rate suddenly spikes from 1% to 50% or 100%, that is the signal that the shorts are being squeezed, that shares are becoming scarce, and that a panic-driven rally could be starting. Until then, the high short interest with a low borrow rate suggests the bears are in comfortable control. The days to cover, hovering around 3 to 4 days, is significant but not high enough to trigger a panic on its own. The short sellers are basing their thesis on the company's fundamentals, specifically its inability to turn a profit after decades of trying. As we look at the recent trading, the stock has been trapped in a violent range, with a 52-week low of 69 cents and a high of $4.58. That high was hit during a previous wave of optimism. The stock is now trying to build a base, and the volume is enormous, averaging over 90 million shares traded daily. This isn't a quiet stock, it's a war zone. The bulls are piling in on the green hydrogen dream, pointing to the Georgia plant hitting record production and the new European deals. The bears are pointing to the balance sheet, the negative gross margins, and the fact that the company is still projected to lose $0.13 per share in the upcoming quarter. Speaking of which, the next major catalyst is right around the corner. Plug Power is expected to report its third quarter 2025 earnings on or around November 11th. This will be the moment of truth. The expectation set by analysts is a loss of 13 cents per share. This is an interestingly significant improvement from the 25-cent loss they reported in the same quarter last year. If the company meets or beats this number, and more importantly, if they can show a clear path to slowing the cash burn without announcing more dilution, the stock could break out. If they miss, or if they guide down, or if the new CEO's plan involves more painful fundraising, the bears, who are shorting 30% of the float, will be proven right, and the floor could give way. What is your long-term outlook on the hydrogen economy, and do you think Plug Power will be the one to finally make it profitable? Comment below. This is the central tension. The expectation is that Plug Power is selling the future. The reality is that they have been forced to sell pieces of their company via share dilution just to fund the present. The stock chart reflects this battle perfectly. It's a series of sharp, hopeful rallies followed by long, grinding declines as the financial reality sets in. For long-term investors, the question isn't whether green hydrogen will be a big market. The question is whether Plug Power will be solvent long enough to see it, and how much of the company will be left for common shareholders if it does. As we head into this week, we are watching that 2.71 level in the pre-market. The upcoming Plug Symposium on November 18th will be another key event where the company will try to sell its grand vision. But investors are becoming more discerning. They have seen the vision. Now they want to see the profits. They want to see a path to positive cash flow. Without that, Plug Power remains a speculative instrument, a battleground for bulls betting on a dream and bears betting on a balance sheet. The expectation is a technology firm. The reality, right now, is a financing story. And everything depends on which of those narratives wins out over the next 6 months.